Wesfarmers has coal, it has chemicals, it has supermarkets, and insurance. The giant company booked a 45% rise in annual net profit, but the market reaction has not been entirely positive. To walk us through Australia's last big conglomerate, we have Morningstar Head of Equities Research, Peter Warrens. Peter, welcome.
Thank you, Vicky.
Peter, Wesfarmers has just reported full-year profit. Did this company surprise on either the upside or the downside?
Probably a little disappointing. The NPAT at $1.535 billion, short of our expectations by about 9.5%, and a little bit below market consensus. We were okay at the earnings before interest and tax line, but the surprise was a very big increase in net interest expense from $800 million to $963 million. And that surprised us because net debt had fallen by $4.8 billion during the year via two big capital raisings. And so that elevated net interest expense reduced the earnings before interest and tax sharply when it got to the net profit line. And so, the bottom line was a little bit disappointing. I wouldn't take too much away from that because a lot of the things are now in the past, and we've got to look forward and see what's going to improve. So, a little disappointing, but the stock had run quite hard, and so that was the reaction to that result.
Wesfarmers is made up of some really diverse businesses. Peter, did any of these divisions stand out?
Well, yes. The short answer is that Bunnings is just so reliable. It has been the feature for a long, long time, and that's probably why Woolworths wouldn't mind getting into that space. They continue to get nice earnings growth. EBIT was up about 11% on a 9.1% increase in sales. Margins up a little bit further at 11.3 from 11, and that are very, very, that's very, very good. Tells you how efficient that operation is. They've got it streamlined and doing very, very well. So that was the feature. The resources division obviously had a record profit, a little bit below expectations at $915 million. The market was looking for a little bit over $1 billion there, but of course that was driven by significantly higher export coal prices, and they have reversed, and so the FY10 outlook for resources will be for a significant fall in the contribution there. Other than that, there wasn't any standouts. They were the two divisions that really did perform quite well.
Were there any disappointments among these divisions?
Disappointments. You could argue that Coles was a little disappointing. However, they seem to be getting their act together gradually, and this is a big chunk of the operation. I mean, $28 billion of sales. They've just got to get it right. The disappointment was that there was really no improvement in their EBIT margin or their operating margin at 2.9%. That compares with what Woolworths are doing around about 7% in their supermarkets. And so that was a tad disappointing. As I say, there are positives to draw from it because the sales growth quarter on quarter and the comparable store growth quarter on quarter are improving. They've just got to get it more efficient. The supply chain's got to be more efficient. They've got to drag out some more costs, and that will push that margin up. And to put it in context, for every 1% increase in margin is $290 million worth of earnings before interest and tax. And so that's the goal that management will be seeking to achieve within the next 2 or 3 years. It is a 5-year plan to turn Coles around, and so we're only 1.5 years into it. Let's hope that they can get it right. Other divisions that were disappointing were those associated with the general economic climate, if you like. The industrial and safety division, earnings were down there because, again, the customers that they're servicing pulled their horns in. chemicals and fertilisers and energy, they were also not disappointing, but they were affected by that one-off Varanus Island explosion, which cut off supply of gas to their operations. So that's a one-off, and we'd expect a rebound there. Insurance was disappointing in that there was an underwriting loss there. The combined operating ratio was over 100% at 103. Elevated claims coming from adverse weather and Victorian bushfires. And I really don't know why Wesfarmers are in insurance. So they were the disappointments, and so a couple of one-offs in there, but I think that those two operations, energy and chemicals and fertilisers, and to a lesser extent industrial and safety, will rebound in 2010.
So, Peter, Wesfarmers has Kohl's supermarkets, it's got Bunnings Hardware and Target and Kmart. Is this company getting too heavily into retail?
Well, Vicky, you could argue that, but it's still a very, very diversified conglomerate. Retail, including those companies that you've just mentioned, account for around about 60 to 65% of group sales. Not that amount of EBIT yet, because Coles is still dragging the chain, and certainly Kmart is. But it's a diversified retail portfolio. I mean, you've got hardware, which is totally different to the necessities of the supermarkets. Target is a discount department store in the if you like, the soft goods industry, which is clothing, etc. And they've got Kmart, which is also a discount department store, but in more towards the hard goods. So, look, I think a pretty diversified retail operation. I wouldn't call it over-retailed. But, I mean, their retail sales are, strangely enough, $47.3 billion in the year just ended, is identical to what Woolworths' sales are, if you strip out petrol. And yet, Woolworths will produce a profit of about $1.8 billion in the year just ended, and here we have Wesfarmers with the whole of their operations, all their operations put in 1.535. So you can see the work that the management has to do to get Coles right.
Peter, what can investors take away from all of this today?
Look, Wesfarmers is a very, very strong and financially sound organisation. It has a terrific balance sheet. It has a gearing ratio now of 18.3%. That's to die for. Cash flow, operating cash flow for the year up at $3 billion, and they are excellent managers of cash. So I would say trust the management. The management has got the focus on Coles. I'm sure that over that period, that 5-year period, they will make some significant improvements in that Coles operation. And we are looking for some above-average growth in net profit and earnings per share from 2011 onwards. 2010 will be sticky because of the significant fall we're expecting in the resources division because of those substantially lower export coal prices.
Peter, thank you for joining us today.
It's a pleasure, Vicky.